Welcome back, everybody. Today, we're going to be doing an analysis of United Rentals. Now, this is a stock that I own in my own portfolio. When I took a look at it, I thought it looked really like a really amazing company in terms of the numbers. So let's see if they've continued to show that. Over the past 5 years, they are up 478%. And yeah, super good performance, way outpacing the S&P 500. Uh, could it be just a cyclical business, cyclical boom benefiting from like construction spending? Possibly. So we're going to try and determine that in today's video and take a look at the numbers. So they are a $43 billion company. They are in the S&P 500. Very large company. Well, pretty large, and they're a rental company, so they rent massive construction equipment basically, and their price to earnings ratio is 20. So not like too steep for a price to earnings ratio. And let's take a deeper dive into the financials. Taking a look at their revenue growth. I mean, this revenue growth is just like insane actually. 6 billion up to 14 billion over the past 6 years. They've had years where they're up 20%. Even in the past couple of years, they've been up 20% in their revenue. They had their only decline during COVID when everybody was locked inside, so there wasn't too much construction going on at that time. But they came out of it pretty strong, and yeah, and now they're up to 14 billion. Even in the past quarter, they still grew 13%, and I would probably expect this type of growth moving forward. For some reason, well, when I looked at the analysts don't expect that type of growth, so we'll have to take that into account as well. It translates pretty well into net income at like 15% margins, basically. Their balance sheet. So this is okay. Check out their balance sheet. They go from $36 in book value all the way up to $120 in book value. This is basically because as they continue to expand, they buy more and more equipment, more and more different rental facilities, and that really drives up their book value. They also take on some debt to do this, but they actually don't really take on all that much debt. It just seems like that they're reinvesting their profits into growth. And that is always what you like to see when management sees an opportunity to grow using their earnings, then that is usually a good thing. Net debt of 12.3 billion, so we'll take that into account with our earnings model. Cash flow, terms of cash flow, they bought back 1 billion in stock last year. I'm guessing they're going to buy back another billion next year as well. And they paid a small dividend last year as well, and probably expect that moving forward. In terms of stats, let's check out their margins. Their ROIC is around 10 to 12%, and their net margin, they had 20% here, and then 10% was their lowest, and right now they're doing 18%. I feel like 18% is probably pretty close to what they're going to continue to do in the future. Especially if they stopped reinvesting so much into new rental equipment and like expanding the business, then I feel like, well, okay, actually that has to do with their cash flow actually, but yeah, I do think that 18% margins is pretty sustainable for this business. Yeah, this is United Rentals. This is their website. They rent like construction equipment, excavators, skidsters, a bunch of lifts, a bunch of stuff, a bunch of different things. But yeah, that's what they rent. So I found this slide from their investor slides, and we can see their equipment rentals for revenue, and then they also sell some rental equipment. So I'm guessing this is where like somebody rents a piece of equipment and it turns out that they really like it and they use it a lot. So then the company just decides to buy it from United Rentals, and that's where the sales from rental equipment comes in. I think that's really great that they allow that. Sales of new equipment, they also sell some new equipment, which is interesting. So it's kind of like a retailer in that way. But yeah, mostly rentals, and they did grow by like 20% last year in the revenues. So I wanted to, yeah, and then it translates super well into gross profit. Super well into gross profit. and pay their workers or whatever, and they end up with quite a bit of net income. So I plugged, well, actually, we've got the analyst. Let's go through the analyst, what the analysts have to say. $43 a share for this year and 47 for next year. In terms of revenue, they're estimating 15 billion, which is only a 5% increase from last year, which seems extremely low. I would think that would be way higher, but that is actually what the company's guiding for, is 15 billion. So maybe that is correct. And then also into the following year, they're expecting just a 4% increase. So I actually put those numbers into the DCF model. Let's take a look at that. And there's the EPS estimate, the revenue estimate, buybacks of 1 billion, net debt of 12.3 billion, discount rates of 10% because I want the 10% return on all of my stocks. Exit multiple of 20, that's what they're trading at right now. I feel like that is super, super fair, especially if they're going to be growing. Well, okay, if they're going to continue to grow a lot, then they could have a higher exit multiple. But since their growth will probably slow after some time, then I think an exit multiple of 20 is solid for this company. In terms of earnings growth, they're estimating 8%, and then I just brought it down some since it becomes harder to grow once you become large, basically. Although with the well, I would say with the rental business, it could sustainably grow. I feel like, yeah, with this, the fair share price is probably like $800 a share, and they're currently trading at 700. And in terms of the revenue model, with 18% margins, which I feel is super, super fair for this company, and a growth of 4 to 5%, even though they did 20% in the last 2 years, and they've had higher growth in the past. They've probably grown at like a 12% rate in the past 6 years compounded. So I feel like this is super, super low for an assumption. But even with this super low assumption, they're still trading at fair value at about $700 a share. And yeah, even with them running up 500% in the past 5 years, they're still trading at fair value, which is actually insane. Just because their growth has matched their stock performance. Now, if they can do better than this growth, like if they could do 10% growth, which I think they could definitely do, then we're looking at a fair share price of like $1,000 or like $900 a share. And if this case were to play out, which definitely could happen, especially since they've been growing like that in the past very, very consistently, then we could say that you'd probably be expecting about a 15% return. Yeah, I'd say that you'd be expecting a 15% return moving forward if you bought the stock today. Even with the massive run up, I still think they're trading at fair value. That is the conclusion of this analysis. I hope you guys enjoyed. Leave any questions, comments, or concerns in the comments section. I do read the comments. Also, hit that like button if you enjoyed, and you can try this spreadsheet for yourself. Check the link in the description. But yeah, that's about it.